the biggest tax break for business owners just became permanent, a 20% deduction on your business income and on $500,000. That can mean tens of thousands of dollars in savings every single year. This video shows you exactly who gets it. For 7 years, this deduction lived under a deadline. The new tax law just removed it for good. That means if you own a business, you can finally plan around a 20% write-off without worrying it vanishes at the end of the year. Did you know most business owners can deduct a full 20% of their business income before tax is even calculated? Did you know that break was about to expire and the new law just made it permanent? 20%. That is how much of your business income you may simply not pay tax on, and it just stopped being temporary. It is called the qualified business income deduction. On $500,000 of business income, a full deduction can be worth around $100,000 off your taxable income, which can save tens of thousands in actual tax. And the new law widened it, so even more owners qualify. By the end of this video, you will know the 4 things every business owner needs to know: the income trap that can phase you out, and the 3 moves to lock in the biggest deduction. Stay to minute 4 for the part that even high earners who think they lost this can still use. So here's what this actually is. If your business is a pass-through, a sole proprietorship, a partnership, an S corporation, or most LLC, your profit flows onto your personal return. This deduction lets you write off up to 20% of that business income right there, on top of your normal deductions. It was created back in 2017, but it came with an expiration date at the end of 2025. Owners spent years not knowing if it would survive. The new law erased that deadline, so it is now a permanent part of the code. Read this part twice. This is about who can claim it and how much. The deduction is 20% of your qualified business income, but it is limited by your total taxable income and the type of business you run. Get inside the rules, and this becomes one of the largest write-offs you will ever take. Here are the 4 things every business owner needs to know. 1. It is permanent now. The deadline is gone, so you can build it into your long-term plan, instead of treating it as a use-it-or-lose-it window. 2. Who gets it? Pass-through owners get it, sole proprietors, partnerships, S corporations, and LLC. Regular C corporations do not, because they are taxed in a completely different way. 3. Income limits apply. Below certain income levels, you can take the full 20%. Above them, the deduction starts to get limited. And for some service businesses, it can phase out entirely. 4. More people qualify now. The new law widened the income ranges and added a small minimum deduction. So owners who were shut out before may now get at least part of it. And here is the part that should make you stop the video. The trap is your income level, especially if you are in what the law calls a specified service business. Things like law, health, accounting, consulting, and financial services. Once your taxable income climbs past the threshold, that kind of business can lose the deduction completely. But here is the key word. The limit is based on your taxable income, not your gross income. That is the number after your deductions. So contributions to a retirement plan, health coverage, and other write-offs lower that number, and they can pull you back into the zone where the deduction works. Here is the move nobody teaches. This deduction is not just for your business income. It also applies to qualified real estate investment trust dividends, with no wage limit and no service business exclusion. So a high earner who lost the deduction on their business can still capture 20% on that investment income. Almost no one uses this. Quick reset for anyone just jumping in. The 20% business deduction is now permanent. It is for pass-through owners. It is limited by your taxable income and your type of business. And the new law widened it, so more people qualify. Here is exactly what to do. Before I show you the 3 moves, let me give you the 1 rule that protects this deduction every year. Quick favor. If this is the first video that made this deduction make sense, hit that like button and drop a comment below. I read every single comment and reply personally. Share this with any business owner who files taxes. And don't forget to subscribe. We put out several new videos every week. Drop a comment. Do you own a pass-through business? Yes or no? I want to see how many of you can use this. Okay, here is exactly what to do. 3 moves. Move 1. Confirm you are a pass-through. Check how your business is taxed. If you are a sole proprietor, a partnership, an S corporation, or an LLC, taxed as one of those, you are in the group this deduction is built for. If you are a C corporation, this is the moment to ask your accountant whether that structure still makes sense for you. Watch this part carefully. The deduction is calculated on your taxable income, not your gross. That single fact is a lever. Every legitimate deduction you take, retirement contributions, health insurance, business expenses, lowers your taxable income and can move you into the range where you keep more of this 20%. Move 2. Know your number. Find your taxable income and compare it to the thresholds for your filing status. That tells you whether you get the full deduction, a reduced one, or whether you are in the phase-out zone for a service business. You cannot plan around a number you have never looked at. Most channels miss this. If you run a service business, the new wider income ranges mean you may now get a partial deduction where the old rules gave you nothing once you cross the line. So do not assume you are excluded. Recheck under the new, more generous thresholds. Move 3. Work the levers with a professional. This is where a good CPA pays for themselves. Things like the wages your business pays, how you take your income, and whether you can group certain businesses together all affect the size of this deduction. A short planning conversation before year-end can be worth far more than it cost. Let me bring it all together. The 20% business deduction is now permanent. It is for pass-through owners. It is limited by your taxable income and your type of business. The new law widened it, so more people qualify, and it even reaches certain investment income. The one rule that beats all of it: manage your taxable income, because that number decides how much of this 20% you actually keep. Confirm you are a pass-through. Find your taxable income and use every legitimate deduction to stay in the zone. Do that, and this becomes one of the biggest tax breaks you will ever claim, year after year. Here is what to do this week. Pull last year's return, find your taxable income, and write down whether you are above or below the threshold for your filing status. Bring that one number to your CPA and ask how to protect the full deduction this year. One last thing before you click off, and there is a deadline you do not want to miss. Right now, manufacturers can get SBA loans with the fees waived to 0, but that window closes this fall. I break down how to use it in the next video. If this video helped you, please give it a like and leave a comment. I read every comment and reply personally. Send this to any business owner you know. And make sure you subscribe, because we put out several new videos a week, all free. And the next video you should watch is how manufacturers can get SBA loans with 0 fees before the window closes this fall. Subscribe so you don't miss it. See you there.